sure all of you can guess. Let me go through my list of things that I was supposed to say at the beginning here. Number one is I'm going to be featured this week, March 5th on Thursday, on the Silicon Valley podcast, believe it or not. And that's a really cool podcast. It's under the Investors Podcast Network. That's Preston and what's the other gentleman's name? It's a great podcast. Preston, who else is the other? Someone tell me in the chat. Preston and the Swedish guy. Stig. How can I forget that? I'm a huge fan of Top Gear. That's right. So anyway, check that out this Thursday, March 5th. Number two is if you guys want to go and meet me in person at the Rick Rule conference at his symposium, that is July. You can go and sign up for that. We've got an affiliate link on our webpage, georgegammon.com. And check out the podcast. This audio will be ripped and put up on my podcast, The Rebel Capitalist Show. And if you guys have time, give me a review. That really helps the algorithm for iTunes. I think that's it. So let's get into the questions. If you guys have a question, you want to make sure that I see it, do a super chat, text, and Sebastian is on the line right now. He will text that to me in real time. And if you have a question just for the live chat stream, go ahead and start with question in capital letters. And, I forgot to turn on the good mic. Oh, well, shoot. Sorry, guys. If this is the internal mic, I apologize. Can everyone hear me right now? See, Sebastian, how am I doing? Is this, I forgot to switch it to the good mic. Sounds fine. Sounds good. Matt, thank you. Anthony, thank you. Okay, guys, and let's get right into it. Tony, thank you for the super chat. Says, what in the world is going on with gold and stocks in the future? Your opinion. First of all, whenever we have a crash, which was basically what last week was, people sell everything. They need liquidity. And that happens to be gold. You look at what's happening in the world, and by every measure, gold should go up as well as the miners. But Eric had a very good quote, my buddy Eric from Macro Voices. He said, when you have a crash, the correlation of all asset classes is 1, meaning they're all the same. They just you've got to sell. So that's what's going on with gold right now. But if you're a long-term bull, which I am, in the miners or in gold, I think it's a buying opportunity. Can it go down? Sure. But when we buy, or at least when I buy physical gold, I'm not buying for the price to go up or down. I'm just buying it as an insurance policy. And if I can get that insurance policy on sale because everyone has to liquidate, then I think that's a fantastic bargain, and I'm going to look into doing that. So personally, I'm actually considering buying gold stocks tomorrow morning. We'll see what happens. Actually, the juniors, because that's what the part of my portfolio that's allocated to speculation. Not sure what I'll do with that, but I'll let everyone know. Okay, going to the chat. Mike O asks, at these levels, what is your thought about investing on margin and scaling in? No. It's still not cheap. That's the problem. It can get cheap. And I'm doing a video tomorrow on how to invest for a recession or a crisis type situation. And I'm going to try to use the cerveza sickness, the word YouTube hates. I'm going to try to use that in the title and still not get demonetized, but we'll see. But I'm going to go over that specifically. And now that said, I think that there's stocks in other areas of the world that are cheap. And I'm actually considering buying that. One that I like a lot that I'm going to talk about tomorrow is Las Vegas Sands, because they're a casino. A lot of their revenue and even more of the profit is generated in Macau. and they've taken a big hit. They've taken such a hit, their dividend is over 5% right now. Not saying that I'm going to buy, but I'm definitely putting that on my watch list. And other things that could pay a good dividend, and maybe overseas that or specific to Asia, that have already taken a big hit. And those are kind of looking interesting right now. Everyone always accuses me of being this doom and gloom and a perma bear and all these things. But I need to remind them that, first of all, I've only been uploading videos to YouTube for what, 6 months, 5 months? How can I be a perma bear if I've just been bearish for 5 months? That doesn't make any sense. I also like to point out that in 2012, as most of you know, I went almost all in real estate in the United States. So it's not that I'm always bearish. It's that I'm bearish whenever the prices are really high. If prices are really low, then all of a sudden I'm bullish. So I think there could be some neat opportunities in the future as a result of what's going on with the cerveza sickness. But I'll be going over that in tomorrow's video. Bennett, thank you for the super chat. Says JP Morgan Chase credit card will not allow me to buy through Ampex silver and gold bullion. Thoughts on why that might be? There's so many moving parts right there, Bennett. What a lot of people don't understand is how credit card processing works on the back end, because most people have never been a merchant or had merchant terminals where they're swiping credit cards. I have. The last business I had, we would do sometimes over $1 million a month. In fact, always $1 million a month in revenue through credit cards. So it depends on the company you're trying to buy. Maybe they have a high chargeback rate. It could be something like that. I just don't know. And keep in mind, I haven't been in that world since 2012. So maybe things have changed dramatically since then. I have no idea. I'm just giving you that information based on my experience over 8 years now ago. So that might be, I don't know that there would be anything nefarious as far as they don't want you to buy gold or it's some kind of conspiracy. I think it's more so something, their risk management on the back end. Hey, Tony again asks, thank you for the super chat. Do you think there is going to be a housing crash soon with a large drop in housing costs? It all depends. If the cerveza deal hits the United States like it hit China or is hitting China or even South Korea, you've got to think about the ramifications. And even if it's not a catastrophic deal from a health standpoint, obviously you feel for all the people who go through the sickness or go into critical care or of course pass away. Hopefully that'll be a very small percentage of the people that get it. But you've got to look at the ramifications of how fragile the economy is right now and how propped up it is by asset bubbles. And those asset bubbles can deflate extremely fast. Remember, a bull market takes the stairs up and a bear market takes the elevator down. And that's exactly what we saw last week. Usually, though, real estate kind of lags and it's much more of a slow mover than the stock market. It's like a giant ship. The stock market can be crashing and everything can be happening. And those sellers that own those homes are still trying to get those high prices that they think their house is worth, or they saw all the comps at when they put their house up on the market 3, 4, 5 months ago. It takes a long time for sellers to start dropping their price. And once they do, they'll drop it real quick. But I don't know that we're going to be there for at least 6 months, even if this, comes through the U.S. like it did in China or is doing in Italy or Iran or South Korea. But I do think that longer term, although it'll lag, there will be an opportunity because prices will go down. Let's remember that chart that I always use of housing, inflation adjusted, going back to 1900. Remember, there's a very specific trend line. And up until 2003, it went up a little bit, down a little bit, but it always would kind of mean revert, which makes sense because it's tied to wages, which to a certain degree is tied to inflation. So in 2003, it just went straight up, just Buzz Lightyear, until it got to 2006. And then it comes crashing down, and it bottomed out in 2012. But where do you think it bottomed out? It bottomed out right on the historic trend line adjusted for inflation. And keep in mind, nominal prices can stay the same, if not increase, while real prices adjusted for inflation can go down. So I'm expecting real estate at some point in time, whether it's now because of the Cerveza deal or in the future, to come down to that natural trend line. And that would be from where we are right now, depending on the market, would be anywhere from probably a 50% drop in some of the bubble markets to 20, 30%. And even some of the linear markets that I like a lot, it could happen. But see, there again, you're buying for cash flow, but that's a whole different topic that we've talked about a lot. I don't want to get into it right now because we've got other things to talk about. But that would be my advice on housing. Yes, it can crash. Yes, there can be a large drop at some point in time. I do think it'll mean revert back to that historic average adjusted for inflation. Could this be the catalyst? It very well could. But even if it is, it's not going to play out for quite a while. Stock market, different story. Bouncer tips. Thank you for the super chat. Hi, George. Are T-bills still a good way to hold money? I've got half my portfolio in 30-day T-bills to keep my powder dry. Absolutely. Yes. Especially right now with the pressure that's coming, the demand that we're seeing for the dollar at the short end of the yield curve and at the Fed funds rate, because that's what they're doing in repo. They're artificially suppressing that short-term rate, Fed funds, that they're supposed to have 100% control over. If that's going over your head, make sure that you watch the interview that I did with Jeff Snyder. I posted part 2 on Saturday, and that will really open your eyes as to how little control the Fed has over those interest rates. But my point is, if anything, they will most likely go down because there's more demand. That means that those T-bills that you'd be holding have a chance of appreciating. I would never, ever, ever buy a T-bill or a bond for that matter, just because I thought the price was going up, meaning the yield was going down. But it's nice to have that tailwind if you're just keeping it for 30 days just to keep that powder dry. I think that's a great move, and I would be doing that myself. Caught up on the super chats. Let's go over to the live stream. Question from West Coast Garage. What do you think of the possibility of the corporate bond? Oh my goodness. Yeah. And Raoul Paul has been talking about this on Twitter quite extensively, and they've been doing a lot of videos on Real Vision. And I know that they've got a lot of their free, if you're not a subscriber to Real Vision, number one, you should be. Number two, that if you're not, you can go on YouTube. They've got a ton of free videos there. A lot of these corporate bond market videos that I think are fantastic. But you hit the nail on the head right there. There is a massive doom vortex with the stock market and the corporate bond market. The corporate bond market has to have stocks going up, or at least staying at the same level, because if they don't, so much of their balance sheet has the stocks that they've bought over the last 8 years, well, now 10 years, that if the stock market goes down substantially, call it 30%, 40%, they're going to get downgraded. All those triple B guys that are just barely on the cusp of being investment grade, they get downgraded to junk. And then a lot of the triple A gets downgraded to, who knows, triple B. I mean, they've got so much of their, they've purchased so many of those shares back, and then they get downgraded. Well, they should get downgraded. Who knows what Moody's will do this time around, but they should get downgraded. They get downgraded, and then that is forced liquidation from those pension funds that have been lending them so much money on margin with leverage. Let's remember that those pension funds that I always talk about, yes, they go and take additional risk going out that risk curve and put that money that they have, your money, your pension money, if you're a state worker, they're taking that, putting it into the corporate bond market, just to get a little more of a yield at triple B, but they're doing it on leverage. So if they can only get a 3.5%, 4% return in the investment grade corporate bond market, they go out and lever up just to get that 6 or 7% that they need. So you can imagine just the implosion of that market if a lot of that triple B got downgraded, because the stock market goes down. The more it gets downgraded, the more the stock market goes down, because the more they have to sell those stocks that they've purchased over the last 10 years for liquidity. And then on top of that, you've got the algorithms, you've got the high frequency trading, you've got all of the passive investment funds now. I mean, how does that unwind, right? And the reason I'm talking about this, I just interviewed Grant Williams with Real Vision. I'm sure you guys know who he is. Just an amazing, amazing guy. Interviewed him Thursday. I'm going to be posting that this Tuesday, but we really dove into that. I mean, Grant obviously knows that so much better than I do, but the market now, for infinite reasons, is so much more precarious than it even was in 2008. Another great thing that he pointed out is back in 2008, the majority of the market participants at that time, even if they were young, went through the bubble and the crash of the dot-com in 2000. So that was fresh on their mind in 2006, 2007, or 2007, when we really started to see these cracks. But now, since we've been in the longest expansion in U.S. history, a lot, Grant said, maybe 50% of the people that are managing money right now, or even the retail investor, they've got their Robinhood account. I see all these millennial kids talking about it on these YouTube channels, and I've got a ton of respect for them, but I'm thinking in the back of my mind, my goodness, they have never felt pain. All they've done is just bought the dip every single time, and it's just worked out to where it's just almost Pavlovian. So that was an interesting dynamic that I had never thought of, that the market participants from a psychological standpoint are so much different than they have ever been in U.S. history, because we're in the longest expansion of all time. Really, when you add that on top of everything else, it's a house of cards. It really is. I'm getting behind on the super chats here. I went off on a tangent. All right. Vilela. Hopefully I'm pronouncing that right. Vilela 1. Yeah, George, I get it. The system is broken. But what is the long-term solution? The long-term solution, in my opinion, is to have hard money. It's to fix the money supply. I mean, fixing it's a strong word. I think there's a strong argument for fractional reserve banking that would increase that money supply, but there would have to be a limit. That it's not fixed, but there'd have to be a limit on it. I think that's a better way of looking at it. And it could, if it's gold, if it's Bitcoin, if it's, I don't know, there's so many smarter people out there than I am that I'm sure could figure out the best way to limit the supply of currency growth. But that's the bottom line. And one thing that I find hard to understand for these people that present arguments on why that's completely impossible and would never work, and it always goes back to credit creation, or the fact that in order for an economy to grow, it has to have more and more and more currency, which makes sense until you think about why are we creating more currency units instead of just dividing the currency units we already have. It achieves the exact same thing. You need more ways to trade your goods and services for another person or entity's goods and services. I get it. But it doesn't necessarily mean that we have to go from 10 to 20. Why can't we just take the 10 that we have and divide it by 10, just like a dollar from a dime or a Bitcoin to a Satoshi? I've yet to hear a good argument why we can't do that. I've heard many arguments, which I completely agree with, that if we did that, it would be catastrophic in the short term. I get it. I totally agree. But the question isn't whether or not it will be catastrophic in the short term. It's if on net balance in the long term, that will be beneficial. That's the question we have to ask. And in my opinion, those 2 or 3 years of severe pain would be well worth it when we get 10, 15, 20 years down the line. I think our kids and grandkids would definitely thank us for making that decision. Jonathan, thank you for the super chat. Says amateur here. Jonathan, join the club, buddy. I'm by no means a professional. I've almost flunked out of high school. I've never taken an econ class in my life. So we're all amateurs here. Welcome to the community. Is it more lucrative or less risky to accumulate several less expensive properties, collect rent, or fewer, more pricey properties? Thanks. It depends on what your RV ratio is. And it depends on the neighborhood. Most of the time, it's going to be cheaper properties to a certain extent. I mean, if you really get into the ghetto areas where you don't want, you've got sketchy renters and places you wouldn't want to take your kids, then yeah, you get super cheap properties there, but that's not what you want. So there's a limit to that. I just really like going into a great neighborhood in a linear market where the renters that you want to be in your home, the people that you think are going to take care of your property, pay you rent on time, where do they want their kids to go to school? That's the question that I always start with, assuming that it's a linear market and I can get a good RV ratio. Then once you look at that, then look at a cheap property that's in that neighborhood and kind of go from there. Generally, it's just a 3-bedroom, 2-bath, maybe 1,200 square foot. Not very modest, just a very nice place to live where a young family can raise their kids and be really happy with the decision that they've made to send their kid to a great school and keep them in that school district going into junior high and high school. That's why I have renters that are still in properties that I purchased in 2012. 2012. They've been in there this whole time. Why? Because when they first rented my property, they had young kids and they've never wanted to take them out of that school district. So hopefully that answers your question. And stick with it, Jonathan. As long as you're really trying to dive into great podcasts. I assume that you're interested in real estate, so not just mine, but make sure you check out Jason's podcast, Creating Wealth Show, Bigger Pockets, fantastic. Just absorb as much as you can. You're going to learn a lot, and you're going to make some good decisions. Tobias, thank you for the super chat. Any update on Yarn Brook? I emailed him and I never heard back from him. So maybe you know what I've had luck with lately though, is when I mention them on Twitter, because a lot of the guys, you can't just direct message them. I've noticed they don't have that option on their homepage. So I've mentioned them, and that I had some success with that last week with Professor Steve Keen. If I'm sure a lot of you know who Steve Keen is. He's on Macro Voices all the time. He's just a really smart guy. And by the way, he definitely not an Austrian. So I'm really looking forward to it, because he's going to give us all a different perspective, and he's someone that I really respect. And I don't think it's good for us to get in an echo chamber of just talking to other people that believe the exact same things that we do. And so that's why I'm really looking forward to the opportunity to talk to Steve Keen. And he really understands the money creation component of it as well. But my point is, I just mentioned him on Twitter. So I did that with Shift today, and maybe I'll have to do that with Yarn, because he's definitely someone I'd really like to talk to. Greg, thank you for the super chat. Hey, George, I've got a joke for you. Oh, boy. Here we go. Should I read this one out loud, or should I pre-screen it here? I'll go ahead and read it out loud. A guy with cerveza sickness. Oh, my gosh. Is this going to be appropriate here? A guy with cerveza sickness walks into a hospital. He is immediately met by Fed Chairman Powell, demanding he take a long-term loan. He dies before signing. Okay, Greg, you've got a pretty dark sense of humor, my friend, but I appreciate the joke, and I appreciate the super chat, buddy. Conrad, thank you for the super chat. Will the Zima sniffles cancel the U.S. Census? I'm not sure, but my buddy Chris with the Quote the Raven podcast, and if you guys aren't listening to that, I think you'd really love it. As long as you're cool with profanity, he can really go off, and I think he's hilarious. He's one of the funniest guys I've ever heard. He really should be a comedian. But yeah, check his podcast out. He's really great. But he came up with some really interesting ideas, like Olympics being canceled. And if you guys saw my Friday video, that was really, really popular. I think it's got almost 90,000 views right now. But I went over how this is really a game of confidence, our economy right now. And that it's just this game of Jenga, and that last Jenga piece is the public confidence in the system. And the Fed and the government are on one side, and reality is on the other side. So they're going to work their butts off to make sure that everything's okay, nothing to see here, don't worry about it, we've got it under control. And then you got the other side where you're seeing all the stuff that makes it seem a little more obvious that maybe it's not under control, and not that it's going to be a Spanish flu type situation. I hope not, but it could get really bad. And regardless of how it gets from a health standpoint, as far as the death rate and whatnot, it's going to take a toll on the economy. That is for sure. I've really done a lot of research this weekend on supply chains in China, and I'm going to be doing a video on it this week, probably Friday. And it's really going to open your eyes up to, oh shoot, this even if it doesn't hit the U.S. hard, this is a big problem for the United States, because call it 50% of the supply chains for the world start in China and to get those back on track and back online. It doesn't happen just like that. Just because the workers go back to work doesn't mean they're bam cranking out exactly what all of these uh, retailers need to fill the shelves. There's a 2 or 3 month lag there at least. So I'll play that out in the video for you guys, but that's really something to think about. Also, so if you've got the Olympics, how does that affect confidence if that gets canceled? You already saw, I'm sure most of you saw on Twitter, that they're considering not allowing the audience to attend the March Madness games for college basketball. Okay, what does that do to confidence when everyone is watching March Madness and seeing no one in the stands? You think that's going to prompt someone to go out and try to lever up to buy stocks? I don't think so. Then what happens if they, and this was Chris's theory, or he threw it out there, what if they cancel Major League Baseball? Because if this hits the US like it hit China, or is hitting South Korea, or Iran, or potentially Italy, it's going to take a month or two for it to hit its apex. And if it's just hitting its apex, you're going to have people freaking out. And are you going to be that the head of the MLB that says, "Oh no, don't worry about it. Just let's keep the games going and let's and then what if one of the players gets sick or gets seriously ill as a result of this?" People, the general public are going to come down on you with the wrath of I don't want to use profanity here, but you guys know what I'm talking about. That's going to be a bad PR situation for you. So do you really want to put yourself in that position? Probably not. But then you're just weighing the economic pros and cons. It's really, who knows how this thing's going to play out. But what does that do to confidence? So these are the questions that we need to be asking ourselves right now, in my opinion. And I'm not saying that this is going to, this is the next Spanish flu or something that's going to wipe out half the population, or some sort of thing that you'd see in the movies. I'm not saying that at all. I think it's going to go through the system like these things do. I think that it's not the flu. It's much, much worse than the flu. But I just think that the economic impacts are going to be far greater than people are realizing right now. And with our economy in such a precarious position because of the amount of debt that we have, that's where I get worried. I'm behind on the super chats. Okay, I got to stop going off on those tangents. Wally, thank you for the super chat. What role does the Treasury General account play in the repo market? I used to think it was only the Fed involved until I saw the Real Vision video. Yeah, that was a great video, wasn't it? I'm sure you're talking about the one that concluded with Raul talking to Dr. Barton Wang. The guy really knows his stuff. I talked to Jeff about that, Jeff Snyder. And his answer, I said, what was his exact answer? It was funny because I don't think we caught that on the recording. I think that's when he and I were just going back and forth, either before or after that interview that I did with him. We went on and on and on. Even after we stopped recording, I should have hit the record button again. But I talked to him about this, and I said, listen, do you think the Treasury has control that they could go around the Fed to do their own round of QE, to juice the market, to potentially give Trump more tailwind going into the election? Do you think that they could pull out reserves by allowing that account to go up that would force the Fed's hand to go in and provide more liquidity? And he just kind of chuckled and said, George, honestly, I don't think they're that smart. He goes, I don't think they could even figure out what you're talking about. That was his honest answer. So I think that obviously Dr. Barton Wang is such an intelligent guy, and it's so obvious to him that you could pull that off if you wanted to. Jeff questions whether or not they have the foresight to even understand how much power they actually have. And I wish I would have had more time to talk to him about it, because as you guys know by those charts that I've shown of the TGA, and if you haven't seen that, make sure you pull up the Fred charts of the TGA. It just starts going crazy with volatility in after the GFC, when Obama was president. But then when Trump gets into office, I think it was 2016 or so, it might not have coincided exactly with Trump, but right around 2016, it just starts going, it goes wild with going these swings that go up to 400 billion, down to 20 billion, up to 500 billion, down to 30 billion, just all over the place. Something has changed dramatically. Now, I'm sure Jeff could show me the rationale for that, but just as a layman looking at that, I say, okay, something's going on, and it looks like they're trying to do it. But who am I to argue with Jeff? But next time I get the chance to talk to him, I'll definitely bring that up, and we'll take a deep dive into it. Jagged Gent, thank you for the super chat. What is your opinion on Ripple, third largest crypto associated with banks? And have you heard of Triffin's Dilemma? Have I heard of Triffin's Dilemma? Come on. What are you talking about? Of course I have. Of course I have. I've used it in several videos. I haven't done a video exclusively on Triffin's Dilemma, which I probably should, because it's a really big deal. It goes back to Bretton Woods and going off the gold standard in 71. But yes, I've definitely heard of it. I know it well. What is my opinion of Ripple? It's my opinion, really, of any type of cryptocurrency, and that you have to compartmentalize it and understand why you're interested in buying it in the first place. To me, it is not an investment. And that doesn't mean that I don't like it, or that it won't go up by 100 times, or that it's not the currency of the future. It just means that I don't think it's an investment, because I consider an investment to be something that pays me to own it. I don't think it's insurance, because it doesn't have a 5,000-year history, and I'm not going to personally put my long-term financial freedom and bet it on something that's only been around for the last 10 years. I could be wrong. And if you think that I'm wrong, I'm not saying that you're not right, or that that's not an intelligent decision. It's just not for me. And I wouldn't suggest anyone do something that I wouldn't do myself. So I hope that makes sense. I just look at it as a speculation. And for me, that's maybe 10% of my portfolio. Right now, a lot less than that. But as I sell some real estate that's going on the market here in the next couple months, I'm definitely going to start allocating that, at least that 10% speculation. I'll keep you guys up to speed on what I buy, of course. But that's first of all, you got to understand why you're buying it. So then you say, okay, it's a speculation. So then you have to compare it to what your other opportunities are. Is it a better speculation than uranium? Is it a better speculation than the silver miners? Is it a better speculation than Bitcoin? Maybe. I just haven't done enough research on it to give you my opinion. And if it were me just having the broad overview of cryptocurrency right now, I'd probably start with Bitcoin. But that doesn't mean that I wouldn't get multiple cryptos, as long as they're in that speculation bucket and I understood and I had a specific game plan as to why I was actually buying them. Okay, are you for 2112? Thank you for the super chat. Ripple or Simular, I'm not sure if that's another crypto, will provide the liquidity but still be a limit of how many are created. Well, that's good. You definitely wouldn't want to get, or at least I wouldn't want to consider a cryptocurrency where that it didn't have a limit. I mean, that's just as bad as fiat. So, yeah, I think you're just making a statement there. I just want to make sure that you're not asking a specific question. Okay, but thank you very much for the super chat. Mark asks, do you think the drop in repo financing last week is related to the drop in asset stock market prices? If so, then do you attribute the recent market run up to repo liquidity? Thanks. This is a very good question, Mark. It's tough for me to answer this thoroughly without a whiteboard. Let's start with your last point. Do I think that the current run up in the market prior to last week was a result of the additional liquidity going into the repo market? Let us be very clear on that, because as you guys probably know from watching the interview I did with Jeff Snyder, we don't know if that additional liquidity is actually going into the repo market. We can assume, because the interest rates are not at 10% like they spiked up to, but we don't know for sure. And I didn't even know that talking to Jeff Snyder. I always assumed that the numbers that I was using in my videos, that I was getting from the New York Fed's website. I'm sure you guys know exactly what I'm talking about, where they give the nightly numbers of the repos and the reverse repos, how much they did in treasuries, how much they did in mortgage-backed securities. And I always thought that's what they were, that those were the transactions that were actually happening in the repo market. That's not true. Those are the Fed, from a logistics standpoint, can't go directly into the repo market unless it's with a bank or one of the primary dealers that are under their umbrella, because those are the only institutions that have reserve accounts with the Fed. A hedge fund, as an example, doesn't have a reserve account with the Fed. And the only way, or I'm not going to say the only way, but the main mechanism for the Fed printing money and trying to get it into the system is just depositing that money directly into the reserve account that XYZ financial institution has with the Fed. So the only way for them to try to get liquidity into the repo market is to print up that money and do that transaction with the primary dealers. Now, are they the ones that need liquidity? Maybe, maybe not. But what we're seeing on the New York Fed's website is the transactions between the Fed and the primary dealers. Now, to Jeff's point, what they do with that money, who knows? We don't know. And like he said, the repo market is just like Vegas, in the sense what happens in the repo market stays in the repo market. And we really have no way, at least in real time, of seeing what is going on. We can only assume that some of that liquidity is getting into the repo market because the interest rates themselves have obviously gone down. We can see, then the next question becomes, if that liquidity that went to the primary dealers, if that did drive up the stock market, why? Did it drive up the stock market because of the increased liquidity? Or did it drive up the stock market from a psychological standpoint? Was it Pavlovian? I think the market participants have been so preconditioned to just assume that when the Fed's balance sheet increases, the market goes up. It becomes kind of a self-fulfilling prophecy. So I think we really need to start asking ourselves the question of why. Just because the Fed prints money and creates all these additional reserves, is that money is the market, the stock market, going up as a result of those reserves somehow, or excess reserves somehow creating more liquidity going into the market, or is it psychological? Why is it doing it? Not just the fact that it is doing it. That's what we really need to start asking ourselves, to have a good handle on what is going on, so that we can make better decisions to protect our wealth and potentially grow our wealth as well, to build wealth and thrive in a world of out of control central banks and big governments, right? Okay, let me go to the first part of your question. Do you think the drop in repo financing last week is related to the drop in asset? I would have to really think that through, Mark, because you've got interest rates on the long bonds going way down. That means the price is going up. That means that the people or the entities that are holding those bonds as collateral, they have bonds that are worth more. So let's say they have 100 bonds, to make the math easy, and those bonds are worth 2-3 weeks ago, let's say they're worth $1,000. Well, now they're worth 1,500, let's say, or 2,000. I'm not using exact numbers, but I'm just trying to make the math easy. So instead of going into the repo market now with $1,000 worth of collateral, now they can go in with $2,000 worth of collateral, not because they have more bonds, but because the face value of those bonds increased by the interest rates going down. But there's going to be a lot more demand for those bonds because of what is happening in the stock market. Therefore, there would be more collateral that would be sucked up into the system. But then if there's more collateral that's sucked up into the system, then they'd potentially have more on their balance sheet to put into the repo market to get cash to put into the stock market or the FX market or wherever they thought they could get a better return. I guess my answer, Mark, is that I can't tell you definitively I think it's doing this. I think there's 3, 4, 5 moving parts that you've got to think through and weigh the probabilities of each one actually happening, and then bouncing that up against any type of data that you can find. As an example, where you're taking the Fed's balance sheet and cross-referencing that exactly with the stock market and see if there's any correlation there. That's really where I'd start to answer that question. My point is I just want to make sure you're thinking about it correctly, because it's not an easy question. It's a very nuanced question. And in order to answer it correctly, you've got to really take a deep dive. John, thank you for the super chat. Most of my wealth is in silver miners. I am down 50% in my stock. The scenario in 08 for this miner crashed and made huge returns. Can we see a repeat? We absolutely 100% can, John. But this is why I encourage people to only speculate with 10% of your portfolio, because especially these miners, they're massively volatile, and it very well can happen, but there's a possibility that it may not. These markets are so manipulated because of the money printing and artificially low interest rates. It's the hall of mirrors, like Jim Grant always says. So if I was in your position, I'd ask myself, do I have too much of my portfolio in this one position, number one? And number two, assuming that you're comfortable with the position size, I'd say, would I be a buyer at these prices? And if the answer was yes, I'd hold the position. If the answer was no, then I'd sell it. But I'd make sure that I was thinking about it I would be owning this for a 5-year time horizon. I wouldn't be too much worried about the price. If 100% of my portfolio was in it, then I'd definitely be worried about the price. But that goes back to what I've said many times before on this live stream, and you guys know well. So I think that's yes, it can happen. And my advice to you would be check your portfolio allocation and then ask yourself if you would buy at this price, assuming you didn't own anything. And that kind of answers the question as to whether or not you'd buy or sell. Alexander, thank you for the super chat. I've heard quite a bit of chatter around downward silver and gold price manipulation. Can you comment on this? And would you consider making it a video? My comment on that is I think the price is manipulated up and down. I don't know that there's any conspiracy from the central banks or the powers that be to keep the price artificially low. I just think that there's traders at JP Morgan or Goldman Sachs, Deutsche, you name it, that are just trying to figure out how they can increase their P&L. And if they have to manipulate the market and do something shady, whether it's pushing the gold price up or down, they're going to do it. And that's my opinion on it. I haven't taken a deep dive. I'm just taking a lot of what I've heard from really smart guys on Real Vision Macro Voices. One guy that's always on Chris's podcast, Quote the Raven, is Bill Fleckenstein. And he's very opinionated and he really knows that side of the market well. So I'd encourage that you go to Chris's podcast and just do a search for the episodes with Bill. Listen to those. I think he can give you a lot better insight than I can. And it's a good back and forth because Chris, I think, believes that the markets are manipulated down. Bill believes that they're just manipulated in both directions because that's what traders do. I would tend to side with Bill. As far as doing a video on it, maybe, for sure. I'm not going to do it this week because I've already got the videos planned out, but it definitely could be a topic in the future, for sure. Alex, thank you for the super chat. Is it better to jump into first family house mortgage now in Tampa area, or is it better to keep renting for the moment, hoping the recession and real estate price drop, interest rates lower? This is a really good question, Alex. Before last week, I would have said it all depends. It's your family house, though. Well, I'd still make that decision based on the RV ratio. But in Tampa, I think they've got a pretty good RV ratios there. In general, I think I've heard Jason talk about that market as though he's either in it or he's thinking about it. So I know if he's thinking about that, it means that it's a good cash flow market. In which case, I'd be more open to buying, even if it's for my main residence. Well, but now, let me put it to you this way. A couple weeks ago, I would have been more open to it. Now, I think if it's something that you got the perfect house, your family loves it, it's in the best area, it's going to be great for your kids, I would go ahead and pull the trigger. If you haven't found the perfect house yet, I'd probably hold off, because if the cerveza sickness plays out like most of us think, in which it's going to be worse than the majority of Americans are thinking, they're kind of whistling by the graveyard. No, I guess that's a bad way to say that, isn't it? I didn't phrase that too well, did I? I apologize for the inappropriate phrasing there, but you guys know what I'm talking about. That there's so many Americans that just aren't paying any attention to this because they don't think it can happen to them. That it's not priced into the market at all yet. The stuff in China outside the U.S. is, but what can happen in the U.S. I don't think is. And if it does, then even if we don't get it like China, even if we just get it like South Korea, I think mortgage rates are going to go down even further. And I think if I hadn't found the perfect house by now, I would be cool with waiting probably a month or two before I pull the trigger just to see how this plays out, especially with interest rates. That's probably what I would do. Jorge, thank you for the super chat. Expecting a deflation in real estate in the USA. I'm considering buying a rental property. I hear also mortgage rates are going down. Good time to buy. Okay, yeah, same thing, Jorge, that I just told Alex. And that 2 weeks ago, I would have said, as long as you got the right cash flow, the right numbers, go ahead and pull the trigger because the cash flow is cheap and the debt's cheap. So I'd say the same thing. If you've got a perfect property right now, I wouldn't pass on the opportunity. If you don't have a perfect property, I might hold off just to see what happens to mortgage rates and maybe home prices and on the demand side of the equation over the next couple months. Conrad, thank you for the super chat. Reach out to Charles Hawkinson Cardano for an interview. Okay, I've never heard of Charles, but I'll definitely look him up, Conrad. I appreciate the suggestion. Toby, thank you for the super chat. If you were 19 today with a few $1,000s, what type of investment would you look for in the future given the fragility of our economy? No brainer, Toby. No brainer, my friend. Most of you, who knows what I'm going to say? I'm gonna ask you guys a question for once here. I'm gonna go right to the bottom of the live chat. Who knows what I'm gonna say? I'm gonna announce the winner. Come on, guys. You know what I'm gonna say. I think this chat is lagging a little behind here. Pork bellies, no. Fourplex, nope. Who's gonna get it first? House hack, nope. Trucks. John Doe, you got it, buddy. John Doe hit the nail on the head. That is right. So, yeah, John Doe, you got it, buddy. Jane Smith got it right. Jennifer got it right. Email account got it right. That's awesome. Okay, let me explain why here before I just completely go off on another tangent, get way behind. Normally I'd say house hack, Toby, but you've only got a couple $1,000 or a few $1,000. So you need to make enough money to get that 20, 30, 40 grand for the down payment to start house hacking. So I don't want to downplay house hacking because I agree with my buddy Marco at Whiteboard Finance that is the best financial decision any young person can make. I totally agree with that 100%. But since you really don't have enough for the down payment, how do you get that 20 or 30 grand? If I was in your position, I would go out, I would go on Craigslist. You guys know what I like. I love the Ford trucks, 94 to 2002, the gas from 94 to 97, the diesels from 95 to 2002 because they had the 7.3 Power Stroke. I would find them in no rust states. That means California, Oregon, Washington, Nevada, Arizona, some parts of Colorado, New Mexico. And I would get them on Craigslist. You get them super cheap where they're a little dirty, a little roughed up. And then I would take them back home. I'd clean them up. I'd polish them. I'd take the most amazing pictures you can possibly imagine. I'd make sure the sun was right, the shadows. I'd write the copy for the ad to where you just could not resist buying that. And then I would put it up on eBay. So what are you doing? It's an arbitrage, basically. You're buying in a local market where there's very few buyers, and you're selling in a national market where there's a tremendous amount of buyers, especially on the East Coast, that don't have any supply of what you have. Why? Because those trucks are rusted out. They don't exist on the East Coast. And there's a lot of those guys that love those trucks, especially the OBS style Fords. That's the original body style, kind of that more square. And it doesn't matter if you got a standard cab, crew cab, extended cab. They love them all. If you can get a crew cab, like a crew cab long bed, whew, that's the holy grail, and you're going to crush it on that. And when I say crush it, what am I talking about? I've bought in 460s, which are the gas motor in California, that nobody wants them out there because gas is so expensive. So they can't give them away in California. I've literally bought 460s for $4 or $5 grand, put 1,000, 2,000 into them to clean them up. So I'm in them for $6, $7 grand. I've sold them on eBay for 14, 15 grand all day long. And I don't even do a buy it now. I don't mess with that. All I do is the 1 week no reserve. Whatever the highest bid is, boom, there's my buyer. And so you're moving it. You got that rotation of capital, and you're turning that capital over more and more, especially now that we're potentially going into a recession and all these asset bubbles around. I would be doing that non-stop. And you're going to have a lot of these older folks that have the retirement in the stock market. If the stock market crashes, they're going to need liquidity. What's the first thing they're going to sell? They're going to sell their diesel pickup truck that they own outright. This could be a huge opportunity. And if you know what you're doing, and I should do a video on this because it's such a neat way to make money. And it's not just trucks. I want to make sure that I'm clear. You take trucks and apply it to anything. It can be baseball cards. It can be sneakers. It can be anything that you know well. And you know what the real price is that you can get from a private party, talk them down, get a great rate, and flip it at a national level and pocket the spread. That's a great side hustle, especially for a young person. And the great thing about it, Toby, is that the process of doing these trucks is the exact same process that I use today to make hundreds of thousands of dollars in real estate. It's the same thing. You're buying an asset cheap. You're making your money on the buy side. You're fixing it up. You're managing people. You're managing contractors. And then you're selling it retail at a huge markup, and you're pocketing the spread. It's the exact same process. So how neat would it be for you to make a quick 20 or 30 grand doing this, and while you're getting an education that will help propel you into a really potentially cool career as a real estate investor. No downside to it right now at all. And for those of you who are looking for a store of value and you want an alternative, or maybe something in addition to gold or potentially silver, look at these diesel trucks. If you can get them with under 100,000 miles, there is no way they will be worth less in 5 or 10 years than they're worth now. No chance. Because it's like Bitcoin. It's like anything else. They're not making any more of it. They're never, ever, ever going to make another 1997 Ford crew cab stick with under 100 grand. Never make it. That you're never going to get more of those. There's only going to be less of them. So there you go. Alex, thank you for the super chat. How do those below poverty line with no assets benefit from the coming great wealth transfer? There's not much you can do other than make sure that you're learning a skill. I mean, we've got so much education at our fingertips right now that's just free of charge. I mean, a lot of the videos that I do, if I don't really understand something completely, I'm like, how does that work again? I mean, I'll go on Khan Academy. I'll go Real Vision, obviously Macro Voices. I'll try to just go to YouTube and see if I can see a really good video on it just to solidify my thinking. Now it's a little different because I'm in a position, fortunately, where I have opportunity to talk to all the people, all these really, really smart people like Jeff Snyder. And I just ask him the questions directly. And I'm really asking him the questions that I want to know, just on a personal level. But I'd start there, Alex, really educating yourself for free. Then if you've got a little money, maybe just buy some silver coins, maybe some gold coins, just to have something to protect what you do have. But I think your best investment is going to be in yourself Why is that? We've got to remember, guys, that our consumption, our level of consumption, is not a result of currency. And we as Americans especially have a really hard time with this. We associate consumption with currency. No, our ability to consume is a direct equivalent to our ability to produce. We have to produce in order to consume. So instead of trying to find what I can buy that will go up in value to increase my level of consumption, although that's great, I like to first start with how can I produce more? How can I produce more in order to consume more? And the neat thing about today's day and age is that you can educate yourself on a topic that you really enjoy, whether that's gardening, whether it's macro, who knows what it is. And there's people out there that really want that information and will really connect with you on a personal level. And you can figure out a way to somehow side hustle that. This YouTube channel is obviously a fantastic example of that. I've never taken an econ class in my life, ever. I almost flunked out of high school. I was a terrible student. But since 2012, I have been obsessed with macro, as you guys can tell. And obsessed on a level that most of you probably can't even understand. Obsessed on an unhealthy level, I would admit. But I've taken that knowledge, and there's people out there, obviously, that really enjoy watching the videos, and it's just been an amazing experience. But that's a good example of that, Alex, and that's exactly what I would be focusing on. How can I educate myself for free with the resources I have online to provide value to others and increase what I'm producing so I can increase my level of consumption or excess productivity, have the savings, and then invest. John, thank you for the super chat. Where do you see silver industry in the near future? Do you see a repeat of bull market or metals after this coming recession? I think the probability is on that side, John. As far as the short term, though, I don't know. I don't have any predictions on the short term. That's just me being honest, because there's so many variables that, I mean, just billions and billions of transactions on a daily basis just in the United States. And what's going on with the cerveza sickness and what the Fed's going to do, and are they going to print? How's the market going to respond to that? There's just too many variables right now to know what's going to happen with any level of certainty within the next 2 or 3 months. Now, if you talk to me about 5 years, then that's when I like to make decisions based on those time horizons, because the probability of us being correct is so much greater. So if I'm looking at that from a 5-year standpoint, then yes, I do see it playing out going into a bull market. Dimitri, thank you for this super chat. Hi, George. Besides bonds and miners, are there any other safety plays left? Well, I don't know that miners are a safety play. I think they're great, but I would still consider them speculative. What do you think will sell off first, junk bonds or treasuries? Junk bonds. Junk bonds. 100%. Not even a doubt in my mind. Why is that? Because treasuries have become something that large financial institutions have to have on their balance sheet because they need it as collateral. The system has a shortage of collateral, as insane as that sounds, with the government running trillion-dollar-plus deficits and providing the market with as much of this paper, with as much of this debt and treasuries as they can possibly create. It's still not enough. And that's why interest rates are going down. That's why Snyder thinks that interest rates, even in the States, on the bond on the coupons, meaning that like the 10-year are going to go negative. Doesn't mean that they'll go negative on the short end, but with the collateral that the banks and financial institutions need, treasuries, there's going to be tremendous demand, especially if this gets a lot worse, and they could go negative. Junk bonds, though, they're not in the same category, because although I'm sure a lot of these financial institutions are holding those and probably trading the junk bonds for treasuries short term and putting them into the repo market without the other participants of the repo market knowing, they're not the pristine collateral. And when I say pristine, you guys know me well enough to know that I don't think it's pristine. That's what the market perceives treasuries to be, the repo market, or the counterparties. That's what they are perceived to be. So no, I think that treasuries are going to have a bid for sure above junk bonds. Now, we could see a situation where even the treasuries are going down in price. That's hard for me to envision right now, but because of the supply shocks coming from China, the supply chains being disrupted, you could see inflation, domestic inflation in the United States, going way up. Would that have a counterbalance to the demand on treasuries for the balance sheet of the financial institutions? Who knows? I mean, there's such a push-pull there and so many cross currents. I have no idea who would win that battle in the long run. But the bottom line is junk bonds, in my opinion, would sell off first. Hi, Viz Economist. Thank you for the super chat and being on the live stream every single week, buddy. I really appreciate it. Futures are already down, are they? Yeah, that doesn't surprise me. But see, what's the Fed going to do tomorrow? That's what I'm really curious to know. Is the Fed going to try to talk dovish that's really what I'm going to pay extreme attention to this coming week, is what the Fed's response is, and then what the market's response is to the Fed's response. Could you maybe do some quick alert videos in the coming weeks if you're seeing something really screwy going on with the bonds, Fed, and repo? This week might be a wild ride. I completely agree. Absolutely. What I've got planned for tomorrow is doing a video on how to invest for a recession. In fact, I had the title. I had it. The whiteboard's just right over there. Obviously, I can't turn the computer screen around, or I'd show you guys. I can't see it because the lights are in my face, or I could tell you the exact title. But it's something like coronavirus investing, how to build wealth in a crisis. I think that's it. So that gives you an idea of what I'm talking about tomorrow. On Wednesday, and I'm going to be featuring clips from my discussion with Grant Williams in the whiteboard video tomorrow. So you guys are really going to love it. Wednesday, I think probably I'll bring this up on Friday's video, where I talk about how the Chinese supply chain disruptions will most likely affect the U.S. economy. I'll probably go into that then, my friend. So probably be this week. If not, I'm sure I'll get into it next week. Miguel, thank you for the super chat. You got jokes, George. Funny guy, really funny. Okay, I don't know if you're referring to the joke that I read of that guy that was kind of dark, or the jokes I do on or try to do. I don't know that I'm that funny, but honestly, guys, when I'm up there just drawing that stuff, and I draw all this stuff on the whiteboard, that's all my handwriting. I do that at each step, and then we shoot the step when I get done drawing it. Honestly, I don't really think of that stuff in advance. I just, while I'm drawing it, I'm like, oh, what would illustrate this better is if I had a stick figure, a Trump here, holding a sign saying, I love negative interest rates or something like that. I'm really just kind of winging it, to be honest with you. So I just try to make it as fun as I can. I know it's really dry stuff at the end of the day, and I just try to give it some sort of color, and just it's really, I just try to communicate exactly what's on my mind, really. And you guys are taking a deep dive into just what I'm thinking that day. That's really what those whiteboard videos are about. So, and that's how I see it. I see, I'm fascinated with markets, but when I see the ridiculousness of it, I can't help but just smile and say, are you kidding me? How this whole thing is a joke, right? So anyway, that's some insight as to the process. And thank you for saying that, Miguel. I appreciate you guys are enjoying the color that we add to the videos. Stacy, thank you for the super chat. I own a building with one apartment making $600 per month. Okay, very cool. I can build it into 4 apartments for 210 grand. So I'm assuming you're building onto that, making 2,800 a month, monthly payment on a common on a would be about 1,700 a month. Is it worth the hassle? So, well, I don't know what you're all in it for, though, Stacy. That's my problem. I know you'd add another 4 apartments for 212 or 210, but I don't know what you're in it to get the 600 you're getting right now. I'd need to know that. I mean, if it was close to the RV ratio that you would get by doing the extension, then I would. But again, this depends on how much money you have in reserve. Is it in a good neighborhood? There's all these things that I'd have to ask and find out. But just assuming all we've got a green light on all that, and you're getting the same type of RV ratio on your current cost basis and your current rents, then if you can outlay 210 and get 2,800 a month for that, I would do that all day long. That is a fantastic return on your money. Not to mention the equity build from doing that. I don't know what your cost per square foot is, but I'd imagine that once you build those, you'll have an asset, or at least that portion of the asset that's worth a hell of a lot more than 210 grand. So you're increasing your net worth, you're increasing the value of the assets on your balance sheet that you can leverage, plus you're getting a great return with the cash flow. If all other lights were green, to me, Stacy, that would be a no-brainer. Miguel, thank you for the super chat. Says no. I think he's saying don't apologize for the tangents. All knowledge is appreciated. Thank you, Miguel. I appreciate it. Thanks for the kind words. Sebastian's telling me to check the time. 1:18. Okay, we've got at least another 10 minutes here. Wally, thank you for the super chat. Do you think it's possible that the collapsing stock market and bond yields end up culminating in a credit freeze? 100%. I'm not, let's see, collapsing bond yields. Yeah, I don't know that the bond yields would. I'd have to think that, oh, actually, you know what? They might. See, the thing, Gunlock has done a lot of research on this, or I've seen a lot of interviews where he's discussed this at length. The U.S., as you guys know, is the only major economy with a major bond market that interest rates aren't negative. You go to the ECB or the Eurozone in Japan, that's really the competitors. You've got negative rates there. So here you got positive rates. If every single major bond market that all of these lending institutions, or not just lending, but financial institutions, that they use as collateral, if they're all trading negative, that has got to have some bad consequences. And Gunlock points this out very well. And I'd suggest looking at a few of his more recent videos on YouTube because he's discussed this exact topic. But I haven't taken a deep dive into it, so I don't want to really give you any this might happen, or this might happen until I do. And I definitely will in the near future take a deep dive in one of my videos because this is a very important topic. As far as the stock market collapsing, 100%, 100%, because that stock market collapse could trigger the corporate bond market collapse. If, oh my gosh, if that just goes no bid, and if all that debt gets downgraded, that could affect that could affect the bank's liquidity right there. And then if somehow the Fed loses control over the short end, as we know they can, Jeff has pointed out in all of his awesome charts that I used on Friday, he pointed out there's no debating whether or not the Fed can lose control of the Fed funds rate. And that would just, everything would freeze. So I got to get to the next question. I want to make sure I'm moving on here, Wally, to give you my best thorough answer that yes, I think the stock market could freeze the credit markets. And I'm not sure that bond yields would, but if the bond yields go negative in the United States, so they're negative everywhere, I think that could have a knock-on effect that could lead to a same type of outcome. But I'm just not sure exactly how that would potentially play out. Dimitri, thank you for the super chat. Precious metals and miners. Investors are patient. Yep. Though bunch of people, tough bunch of people. We will survive this and we'll prosper. Yeah, I agree, Dimitri. But I think it's much easier to do that if you're not 100% into precious metals or 100% into anything. I just don't think that's a good move. I'm not saying you are, but I know a lot of guys and gals are just 100% gold or precious metals or miners, and I don't think that's the right move. I think, but it's definitely like a mandatory part of every person's portfolio because we're all in it for the long run. Damon, thank you for the super chat. How long before the later sickness is a huge disruption for the global economy? I already think it is. Did any of you guys see the manufacturing numbers for China? Oh my gosh, they just, as you would expect, dropped right off a cliff. The supply and these supply chains have a lag. We've got to understand that. We're not going to see the major consequences of China being on lockdown for at least another 2 or 3 months. And I don't see how it doesn't affect the global economy. Does it take it into recession? I think that nothing is a certainty, but I think that if I'm betting on that right now, I would say the probability is definitely on the side of it taking the whole global economy into recession. Let's not forget that the U.S., as far as interest rates, is the cleanest dirty shirt in the hamper, and we're only at 150 basis points. How does the ECB combat a recession? How does the Bank of Japan do that? What are they going to go down 5 basis points? 10 basis, 15 basis points? Is that really going to move the needle when per the Fed, per their models, and of course we don't really agree with those, but they always say that they need at least 500 basis point drop in order to cushion a recession. But where are you getting those 500 basis points? They don't exist right now, especially not in Europe and Japan. So I think that's another thing to throw on the fire as to how this could really get ugly. Stacy, thank you for the super chat. Do you see the housing markets in places like California will finally start to fall due to the cerveza sickness ordeal? Yeah, especially like places like Vancouver, and where you had all these Chinese buyers and all that liquidity was coming in and really driving up or propping up prices. I know LA is like that. Of course, there's a lot of factors that go into it, but LA, San Francisco, a lot of that is Chinese money, and that now, whether that increases or decreases, I would think that first would decrease, and then it could potentially even increase. But for the short term, those markets are just so fragile right now because of all of this money printing and asset bubbles. And I mean, just look at the prices compared to 2006. There's no one that would argue that housing prices in LA or California in 2006 were not in a bubble. No one would argue that. But we're higher than those prices now, even adjusted for inflation. So if we were in a bubble in California, then how are we not in a bubble right now? It just makes no sense. And I think Schiff said it extremely well on his podcast the other day. He says what really matters is the size of the bubble. The size of the pin doesn't really matter that much. It's the size of the bubble. And I think that's a great way to look at it. And I think that's the way I see California real estate. But what's interesting, though, I want to add to that, because it's not really cut and dry, Stacy. Because if you have interest rates going down as a result of the cerveza sickness on the 10-year, say they go into negative, what does that do to interest rates? That takes interest rates on mortgages 50 basis points. Then you've got a really counterbalance to the lack of demand. So as I think this through out loud, I don't know. I think there's a good argument for both, but I think my base case on that is going to be that prices fall, even with the lower interest rates. That's going to be my base case. I could see an argument for both. A legit argument for both, but I would side with that. Yeah. Hi, Viz Economist. Thank you for the super chat. Maybe touch on what buying SDOW, SQQQ, inverse, 3X, and TVIX will do in a crash. It's what I'm in, and it did amazing last week. Maybe good fit for recession video. Yeah, I'm not sure. I'm assuming that you're talking about the like a VIX, a way to play the VIX, go long volatility. So assuming that that's what you're talking about, because I don't know all these ticker symbols. As you guys know, I'm more of a macro guy, but I'm going to assume that's volatility. Yeah, okay, for my recession video tomorrow, I think that's a good point, but I would stipulate that is a speculation, and it would have to be considered as that when you're creating and you're building that portfolio that is optimal. So, but I appreciate the suggestion, and I think that that's a good point. If I can fit it in there, the problem, to be honest with you guys, it's really hard to get as much content into even a 20-minute video. It's really hard, and I get kind of frustrated sometimes, even with myself, because I feel as though I kind of just skim right over the top of the surface of a really important detail, and I just like, man, I really need to explain that better, because it just feels like I'm taking this 30,000 foot level approach to it just to present the topic in 20 minutes, and even to get it that low, let alone 10 minutes or something like that. So it's this balancing act that I'm always doing as to how far I can really dive into how thorough I can be with each video, while keeping it at even 10 or even 20 minutes is way too long. If you look at what the YouTube professionals suggest that you do, they like it to be around 10, 12, maybe 15 minutes. So just keep in mind, guys, when you're watching my videos, if you say, oh man, George kind of just seemed to skim over that, it's not because I don't want to go into it deeper. It's that I just have to prioritize certain things to keep the videos under 20 minutes to where they're actually digestible. If I keep them at 30, 40 minutes, then the views are going to go way, way, way down, and I'm just not going to reach as many people, and then it's kind of counterproductive. So that's the balancing act that I'm always going through, just FYI. Oh man, I got a ton of super chats. Okay, guys, no more super chats, please. I really, really appreciate it. But I've got to get dinner and get tomorrow's video ready, and I'm going to be here. I'm really going over right now. So let me go through these, but no more super chats, guys, or else I'm not going to be able to answer them. Eric, thank you for the super chat. Do you have any thoughts on buying Singapore or South Korea ETF? Yes. This is one thing that I'm not the ETF, but I was thinking about the airlines, because I love those airlines. Not necessarily from their balance sheet. I need to look at that further. But if you've ever flown like Singapore Air or Cathay Pacific, oh my gosh, compare that to like United or American Airlines. And, what a night and day difference. But I know those airlines have gotten crushed, and I think it's something to look into right now, for sure, 100%. Yeah, right now they're really low. I just glanced at the airlines briefly today, and I know I think, if my memory serves me right, I saw some down around like 12 PE, decent dividend. Yeah, I'd look at it. And again, if you want, just kind of, I'm not really a stock tip guy, as you well know, but what I was looking at today was Las Vegas Sands. You can buy it in dollars. So if your expenses are in dollars, you don't have any currency risk, but you can get that exposure to Macau, which right now is really depressed for obvious reasons. And let me tell you what, the Chinese will always gamble. It is a part of their culture. It is just what they do. And any of you that have spent time in China or around Hong Kong, you know exactly what I'm talking about. The Chinese are all about gambling, and that's never, ever, ever going to go away. Cody, thank you for the super chat. It says, love your videos. Keep it up. I have several guys I work with drinking the Kool-Aid. Okay. Hopefully they're drinking our Kool-Aid and not the Fed's Kool-Aid. Keep up the good work. I will do, Cody. Thanks for the kind words, buddy. And thanks for always being on the super chats and the comments. I really, really appreciate it. Aurora Borealis, thank you for the super chat. George, what do you think about holding mining stock versus physical metals? Depends on what your objective is. If your objective is to buy insurance, then you got to go physical. If your objective is a speculation, then I would suggest the miners. That's really what it boils down to. Mr. Scott, Thank you for the super chat. Considering pinpoint investing 70% of my Roth IRA in gold mutual funds. Any ideas for the other 30%? My 401k has limited options. Not sure what I can do. Are there any? See, again, we're getting really heavy, and we're just putting all of our eggs in one basket. I really hesitate to do that. I mean, it wouldn't matter how bullish I was on an asset class. I would never go in 70%. I mean, right now I try to be, I don't know if in a Roth IRA you can go into cash and just put it into short-term T-bills. I would try to do that with at least some of it, just to keep some powder dry. Because I do think that if this plays out and continues to play out like we've seen over the past week, not that I'm saying that it for sure will, but if it does, there's going to be some buys even in the US market. I mean, Coca-Cola is down. You guys know well, I really like Coca-Cola. I would love to buy Coca-Cola at $20 or $25 a share, where it got down to in the last recession that we had. That would be, oh, I would love to just back up the Brinks truck, but I still wouldn't go 70%. I would still keep it diversified. So I'd like to have some dry powder right now, in addition to the, and also if you're going into the gold funds, no, I don't like that. If you're talking about the gold funds compared to physical, I don't know, maybe you can't buy the physical with your Roth IRA, but boy, I don't like going into gold ETFs. Not at all. The miners, okay, I get it. But, and if you're trading, I mean, I had this discussion with Luke Groman, and he doesn't mind the GDX just as like a trading vehicle. And I totally get that. Makes sense. But if you're buying something, if you're buying gold, an ETF is a long-term play in your portfolio. Oh, man. I would not do that. Now, these could be miners. And if they're miners, okay, I totally get it. But then the miners, you're going 70% to something that's extremely speculative. I would just try to have some more diversification and try to have some more dry powder. I think that's my best advice. Fiaz, thank you for the super chat, my friend. The global economy seems like a Ponzi scheme. Yeah, it does, doesn't it? To support U.S. consumers and the U.S. dollar. Bingo. Nail has been hit on the head. So maybe the rest of the world has no option but to prop up the U.S. as they also lose their long-term savings. Yeah, because so much of it is denominated in dollars. And then also keep in mind, to add to that, so much of the worldwide debt, not just sovereign debt, but also corporate debt outside of the United States, is denominated in dollars. So that props up, that goes back to Brent Johnson's dollar milkshake theory. There's a lot of cross currents like everything, guys, but there's so much tailwind right now for the US dollar. And but then again, it goes back to what the Fed is going to do this week, and what type of balance sheet bazooka are they going to come out with if the cerveza sickness gets bad. What's going through my mind right now is, even if they do a garden variety, it sounds crazy to say that now, version of QE, where it's all just what Snyder would say, an asset swap on the Fed's balance sheet with the primary dealer banks. It's an asset swap, meaning just treasuries for reserves. Then how does that get out into the real economy? It most likely won't. But if they do that just to support the market, and if the market still goes down, if the market has had enough and says, I don't care about the money printing, I don't care about the QE, I don't care about any of these stupid acronyms that you Federal Reserve PhDs come up with, the market's still going down, Then what does the Fed do? Well, we know the only thing they can do is print money and lower interest rates. And if they're at the zero bound, it's MMT. MMT to the rescue. Then the question becomes, what does that do to the dollar? That's why this is just such a fascinating three-dimensional puzzle that we always play. And it's like this Rubik's Cube that it's just why I love it so much. But unfortunately, it puts us all into a position where we can't make there are no definitive conclusions. There's only probabilities, like I always say. And I think the good news, Fiaz, is you're looking at it the right way. You're asking the right questions, and you're really thinking this through. I agree, to answer your question specifically, I totally agree. It's like a Ponzi scheme, or I don't know if that's the exact way to look at it, but it's totally unstable. It's a house of cards. It does prop up the U.S. consumer. It does prop up the U.S. dollar. And right now, the rest of the world doesn't have an option because they need those dollars to transact, and more importantly, they need it to pay off all this dollar-denominated debt that they just went wild with back in, what was it, 2012, 13, when the DXY was down at 70. So, all right, guys, to wrap things up, I'm going to remind everyone about the podcast that I'm going to be featured on March 5th. That's the Silicon Valley, and that's under the Investors Podcast umbrella. And the Rick Rule affiliate, if you guys want to meet me in person, I'm not going to be speaking there, but I'm going to be there. We can grab a beer. You can ask me any questions. I can ask you questions. Try it. If you're going to go up there, guys, I'd really appreciate it if you used our affiliate link. It's at georgegammon.com. That just helps out the channel, and it's at no additional cost to you. And I would suggest doing it quick if you're planning on going, because the prices gradually rise. I think it's only like $4.99 or $500 now, but like, I'm not sure the exact time frames. You can click on the link to Rick's website and it shows you there, but it goes up to like $6.99. I think, I forgot if that's the highest price point or $7.99, but it gradually goes up. So it's definitely advantageous to get your tickets right now for that event. And then lastly, make sure you check out the podcast and try to review that on iTunes if you guys have time. It really helps us out with the algorithm. And on that note, guys, let's pay attention to markets this week. It's going to be a roller coaster. It's going to be a wild one. And I will look forward to seeing all of you on tomorrow's video. Have a good one, guys.